Okay, so chapter 8, master budgeting. So what do you think a budget is? Heard of budgets? You have a personal budget. What do you do with your personal budget? So you have to know what you have coming in, right? How much do you have that can go out? What are the things, the priorities that you have to go out? And then what do you have at the end, right? So that's what we're going to walk through, but on a production standpoint. So we're going to walk through all that, but we're going to go through all the definitions and stuff first. Okay, so what is a budget? So it's a detailed plan, and it's usually everything's budgeted based on your financials, and the company will normally put one together for one period, which is usually a year. Most organizations work in 12 months. It doesn't have to be a calendar year, but usually when you're looking at that period of time, you're creating it for the whole year. So for my organization, we set it up, we start around September. We run on calendar year. So we'll take September, October, November, and we're working on budget. We're putting it together for the next year. And then some companies use a perpetual budget, which is just the 12 months that continually rolls forward. So they may make adjustments periodically throughout the year, it could be quarterly. All right, so operating budgets ordinarily cover 1 year, corresponding to the company's fiscal year. Many companies divide the annual budget into 4 quarters. So what my organization does is we do create the budget, and then quarterly, we have a comparative report that'll run the budget, and then it runs your actuals. So you can see where are the variances, why are we having variances? And the board wants to see where are the variances, why do we have these variances? And so we have to notate some of those things. And usually you have an amount that you're looking for. It has to be above that in order to make comments on it. There's companies that have special software that's for the budget. They'll put all this in a special software. And there's ways that you can go in there and run it and see what's actual versus budget. Make your notes. So a lot of times, organizations will do this either monthly or quarterly. I would think that quarterly is probably the most popular, but you can do it however your company, wants to set it up. So if you have that 12-month rolling forward, I would imagine that you probably have something in place that's part of their normal routine that's going to look and evaluate, and then they're going to set up for another one. So with production, which is what we're going to look at, you're constantly looking to see where's the, what does our supply look like? What's the demand look like? Are we needing to produce more? So this 12-month could be something that's used in production companies. So if you end up somewhere where you have a production company, this might be something that you're looking at the rolling 12 instead of something that's just yearly and comparing quarterly like we do. Okay, so we have planning. So it involves developing objectives and preparing various budgets to achieve those objectives. So I was telling you how a lot of times we have to get with different management teams in order to get information. So we're in the accounting department putting it together, but I don't know what's happening out in, let's just say we have an office building on Causeway. We have a property manager that's there. That person's on the front lines. She knows who the tenants are. She knows what the leases are, who's getting ready to renew. Are they going to renew? Do we have a new client that's coming in for a vacant space? What types of repairs need to happen on the building this year? What's, something that's got to take priority? It has to happen. What are the wishes? What are we going to hope that we can get through to the budget to improve? Maybe we want to do some updates in the parking lot because we have some little cracks and the paint's kind of messed up, but it's not a necessity. It doesn't have to happen this year. It can maybe happen next year, but they may try to throw it in. So you don't know. So, us in accounting, we're looking for the input from a different team. So that requires planning. So we have to plan out what type of reports do we need to send them if there's going to be some kind of forecast for the current year. What type of information am I looking for from those management teams or the lower level management or some of the teams that work for them? What am I looking for from them? So it requires planning. And then we have to have control. So that involves the steps taken by management to increase the likelihood that the objectives set down while planning are attained, and that all parts of the organization are working together toward that goal. So that makes sense, right? We have all this time we're putting into the budget. We want to make sure that we maintain control of that. And are we looking at it? Is it useful? Are we using it? We don't want to put all this time into something that we're not using and it's not going to be useful. And so we want to make sure that we're trying to stay on task. We're looking to see what projects did we budget for that year. Did something pop up? Maybe we didn't budget for roof repairs, but something happened and we have a damage and now we have to get it fixed. So maybe we have to put a project on hold. So we're still trying to meet the goals financially for an organization based on what we've set in place. There's always going to be the unknown, or might put a contingency in there to allow for that. And then maybe you put something on hold that you originally budgeted for. In the end, you're still working towards those goals of being profitable and trying to stay on task what you have that you've planned and you budgeted for. So why do organizations create budgets? So we're defining goals and objectives. We don't want just people out there like, oh, I don't know, maybe we'll produce 100,000 units this month, but you only sell 20. So we want to do something like that. You have these technology companies that sell these technical pieces, the projectors and cameras and all these things. Well, what if they start producing a lot of those products and there isn't a demand for them, then they're sitting on them and technology changes so often, they go obsolete. Well, that's not, setting something in place that's been planned out or thought through. You don't want to be frivolous. You want to set those goals and those objectives. You want to plan for the future. You want to know your means of allocating resources. So maybe an example like what we do is we have maintenance people, but they don't always just stay at one property. We might use those people and allocate them to other properties. So maybe we have someone like that in the production or plants or wherever you have these people that can be useful in a mechanical sense in more than one location, and you can allocate those resources. We can uncover potential bottlenecks. We don't want things to get too jammed up and cause production to stop. We want to make sure that we have enough resources in order for that to not happen. So what happens if you have a plant and you haven't planned out properly, you don't have the amount of people that you need on a team, and then you're shorthanded. So what happens? Now you have to work with people overtime. They're tired, mistakes happen. Things aren't always great. The reason why I'm using that as an example, because that's what we're going through right now with my husband at the plant. They seem to be having trouble with qualified people in the department, and it causes the people that they have to work overtime and not have enough of a break. And so then mistakes happen. And sometimes with these production teams, especially if it's a chemical plant, it can be very dangerous. I was on the phone with my husband last night and something happened at the acid plant. And he's like, hang on. And I hear him on the phone, like, I see a blue cloud outside, get ready past my garage. He's like, yeah, we see it, just stay inside. We asked everybody to stay inside. It should clear up in a little bit. So what happened? Who knows? But you got to make sure that you have enough staff and you have enough planning that goes into play so that you don't have dangerous situations, especially in chemical plants or oil plants. So anyway, you want to coordinate the activities, communicate plans. So all of these are benefits to creating a budget. So having that budget helps people stay on task, helps you to know what's up and coming, helps managers to maintain what the team is supposed to be doing, what they're supposed to be working on. Are they hitting their goals? Okay, so from a control standpoint, organizations compare their budgets to actual results, which we talked a little bit about this. You'll see usually you'll have some kind of report and you'll see where did we budget And what was our actuals? Are we on task? Are we not on task? How can we improve? So, so you'll evaluate, reward employees, plants or, production teams. They're real good on rewarding based on production and safety. There's a lot of different types of organization that reward for safety. And so, and there's a reason for that, because you want to make sure that everyone in these production departments have all this equipment, sometimes toxic chemicals, you want to make sure everybody's safe. Okay, so companies usually create budgets by relying on some combination of the top-down budgeting and self-imposed budgeting. So we talked about this a little bit, is like, the top-down is your management team, but your self-imposed is where you're kind of getting more people involved, getting those teams involved that are more knowledgeable of what's happening. It's a full cooperation and participation by the manager at all levels. It's not just that top level. So this is diagram of what a self-imposed budget could look like. So you have your top management, you have those middle management, and you have the supervisors underneath. So those supervisors underneath, they're on the front lines. They know, and they know how everything's moving around in operations, so sometimes the top level management, they're not hands-on. And so they may not know enough detail to give good input into creating the budget. So you'll have the supervisors kind of feeding the information up. There's things they want. The supervisors below are gonna move it up the chain. They'll be part of the process. So advantages of those self-imposed budgets: shows respect for their opinions. So when you have employees that are under you and you're all in management, know that those employees that are doing those day-to-day jobs, they are valued because they have the knowledge that they need to give to you in order to help maybe streamline things or make things more efficient. So you want to respect those that are on those front lines, and it gives them a way to feel part of the organization. So also the budget estimates, they prepared by frontline managers, they're often more accurate than the estimates prepared by the top management. And again, that's because they, have more input. They're doing those day-to-day jobs. The motivation's higher, you have the commitment from those employees, and then it empowers them to take ownership. So if you know that you've been part of setting up a piece of this budget, you're gonna, feel like you're part of that. You're gonna wanna maintain whatever you have to do to meet those goals. And it makes you feel like you have accomplished something personally, a goal that you've set. So self-imposed budgets should be reviewed by higher level. Obviously, we want to have our top management review. Those managers should be knowledgeable enough to be able to look at the input that you're giving them and know, okay, I need a little more, or we kind of focused here, but we need to tweak that. They should have an input on what's coming in, and they should know if that information seems reasonable or is it not. And then you have most companies issue broad guidelines in terms of the overall profit or sales. Lower level managers are directed to prepare budgets to meet those targets. Okay, so this kind of gives you a diagram of the budget itself. And we're going to walk through an example budget, setting all these things in place. So we want to know what our sales budget is, because we need to know what to produce. We need to know what is the demand. So we have our sales budget. We're going to have selling and admin. You'll see it kind of goes off the side to come down into the cash. We're going to be spending a little money to sell those products. We're going to have administrative fees. We're going to have advertising fees. You're going to have things that are going into selling. And then that is going to be cash going out. You're also on the other side, you'll see the arrow come down from sales budget that goes right into the cash. And why? That's because when you sell something, you're getting what? Cash or electronic funds that goes to the bank and you never see cash. So if you're in the marine industry, they used to pass a lot of cash. They didn't do a whole lot of electronic transfers, but where I'm at, we hardly have cash at all. Tenants pay online, they do. You can go online and pay it, or they can send through ACH. A lot of these big companies that are ordering large quantities of something that's been produced. I mean, think about Walmart. How much do you think Walmart's actually paying cash for something? That's all electronic transfers. Okay, so then we move into our production budget. We have to know how much are we going to be producing? What does it cost? Do I have my sales numbers high enough to cover those costs? What's my inventory look like? What's coming in? What's going to be at the end of the inventory? What type of goals do I need to set in order to be productive in the next month moving forward? So I may produce some this month, moving into that next month based on what I feel is going to be necessary coming into the next few months. So think about like seasonal items that are produced. So all these companies that sell Easter eggs, we just went through Easter, and these little plastic eggs, they probably ramp up production a couple months, 6 months before that stuff hits the stores. They want to make sure they have their product, and then they pull back, and maybe they start producing something else later in the year. So you need to know, what is their inventory going to look like? And then it goes into what materials are we going to need for this production? What type of manpower are we going to need? We have direct labor budget. And then what does our manufacturing overhead have? We've been talking about manufacturing overhead throughout the entire semester. We have these, big facilities, plants, and we have our corporate offices. And so what does that manufacturing overhead look like? How much of that's going in? Then it all leads to cash budget. Of course, we will go through the cash process, what's coming in, what's going out, and to make sure that we have enough cash on hand that we can cover all of this production. What do we need to sell in order to have enough to cover everything? How much markup do we need? And then we'll have the budgeted income statement and the budgeted balance sheet. We'll look at both of those. So once you put all those into place, then you can pull over your expenses. You can pull, like, inventory is a balance sheet item, right? It's an asset. So we're going to look at those different assets. Cash is an asset. Accounts receivable is an asset. What do we have as far as liabilities going out? We need to know all of those things in order to have good cash flow. Let me make sure Chris isn't here. Last week he texted me to send him the link. He hadn't sent anything, so I guess he's not coming. Okay, so to help see the big picture, keep in mind that the 10 schedules in the master budget are designed to answer 10 questions, and we're going to go over those 10 questions. So how much sales revenue will we earn? How much cash will we collect from the customers? How much raw material will we need? How much are we going to have to purchase because we have to use the cash? How much of the manufacturing costs will we incur? How much cash will we pay to our suppliers and to our direct laborers? How much cash will we pay for manufacturing overhead resources? What's the total cost that will be transferred from finished goods inventory to cost of goods sold? That means I'm taking it out of inventory and I'm selling it. And so my cost of goods moves on to my income statement. How much selling and admin expense will we incur? And how much cash will be related to those expenses? Again, we got to have enough cash to promote our products. We can't overspend. How much money will we borrow from or repay to lenders? Maybe I have a loan. How much is that interest going to be? How much operating income will we earn? And then what will our balance sheet look like at the end of the budget period? Hopefully we're in the black. We made some money and we have some good assets on the books. Okay, so a master budget is based on various estimates and assumptions. So for example, the sales budget requires 3 estimates assumptions as follows. What are the budgeted unit sales? What is the budgeted selling price per unit? What percentage of accounts receivable will be collected in the current and subsequent periods? So in the first accounting class, we really went over what does accounts receivable look like? What does payables look like? So remember, accounts receivable means we're receiving money from someone in the future. And then the accounts payable is we're going to have to pay out the money in the future. So we need to know, what does that look like for those receivable customers? Did we set up net 30 terms? Do we set up net 60 terms? Do we have any kind of discounts to give them to collect money up front? So maybe you need to have some extra cash coming in, so you might want to offer, okay, I'll give you 2% off if you pay me within 10 or 20 days. So you're getting that turnaround a little quicker. Maybe you're a larger organization and the clients or the customers that you're dealing with, they don't want to pay unless it's 60 days. So you're not going to get the business unless you offer these long terms. That's important to know because that's your cash flow. So if I know that I have 60 days that I'm giving people to pay me, then I have to be able to budget that way, knowing that I'm doing all this production, I'm spending all this money, and I'm not going to get it turned back around for another 2 months. So you have to have that cash, those assets up front in order to be able to stay in business with that. So they're showing you that we can use Excel for the master budget. So a lot of the examples are going to go through the Excel. I haven't looked at the, there is an example on there for Excel. I almost hate to give Excel because I know that sometimes it's quirky on what they're looking for and how to put it in the cells. And I think those assignments are useful, but I don't want you to get stuck in formulas. You will be using Excel a lot in business when you're in the fields, when you have your job. It's something that a lot of people use for many different reasons, but we're going to go through all of these examples, then you'll see some of the Excel, some of the formulas that are in there and what it looks like. Okay, so we're moving into our example. So we have Royal Company. They're preparing budgets for the quarter ending June 30th. So we have budgeted sales for the next 5 months. So we've come up with how many units we're selling for these next 5 months. And we know the price that we're selling them for. We're selling at $10 per unit. So we need to set up in our spreadsheet, what is our income going to look like, our sales revenue? What does that look like for the next 5 months? So let's look at the Excel sheet and see how they laid it out. So maybe when you do your personal budget, I do this, I use Excel for my personal budget. Every month has one. I think I still have the same file from 2015, so there's a lot of tabs. And so basically I just keep copying it forward into the new month, and I put in there, my dates of the pay dates for my husband and I have it listed out in date order for the month. And what do I expect my starting balance to be? What kind of cash do I look like I'm going to have when I'm entering into that month? What are the bills that are due and when they're due? When is those paychecks coming in? And I just kind of lay it out for each week for expense and income. And I just do that every month. So this is very similar. We're doing the same thing. We're just looking at months. We're going to look to see how much do we think we're going to have in sales, what's the cost going to look like, what's the expenses, we're going to walk through all that. So they have their columns set up April, May, June. So we have 3 months in the quarter. And at the end, we have where it says quarter, you could, put third quarter, second quarter, whatever you want to put as the description. It doesn't just have to say quarter. And it's going to total up those 3 months. So in April, we're budgeting to sell 20,000 units at $10 a piece. So all you're doing is in this cell, more than likely, there is a formula. That's just the 20,000. So you can grab that cell and times it by the cell with the $10 in it. So now I have my calculation there, which is very nice. I didn't hard key that 200,000 so that when I go back, I'm always trying to figure out when I'm at work and I'm setting up spreadsheets, especially if I'm projecting. I want to make sure that I have cells that, what if they change the forecast? What if they say, okay, let's go with this scenario? I want to be able to plug that number in and it all just work through the formulas. So if you put a formula here, if somebody comes in and says, okay, we're changing the April budget, we're going to 30,000, you can just go in that cell and type 30,000 and it just puts 300,000 for you. So it makes it much easier. So you want to work smart. So anyway, so this is the example of what it looks like for our sales budget. Now, we need to know, how are we collecting the money from those sales? What does the pattern look like? So it says all sales are on accounts. Royal's collection pattern is 70% of the month of the sale. So whenever I sell it, I'm expecting I'm going to get about 70,000 in cash back from those sales. And then the following month, I'm expecting to get the 30%, the remaining. So in April, March 31 accounts receivable balance of 30,000 will be collected in full in April. So they're giving us that information because we're looking at April. We don't have March's information, so we need to know what are we expecting for those collections to be coming forward. So remember how I said I like to set mine up with what is my cash balance in the bank account going into that new month, and I'll put that number there. So this is kind of the same thing. I'm expecting to have that 30,000 come in. So I need to put that on my spreadsheet. So here's our budget for accounts receivable, and we're saying that we're collecting in April 30,000 from those March sales. Now, how much is it going to be for April? We're saying April sales are 200,000, and it told us that we're going to have 70% of that. So we're going to have 200,000 times 70%. Oops, put 0. 140,000. So I know I have 30,000 coming in from March. And now from April sales, I'm going to have 140,000. So I know that's how much cash I'm going to collect for the month of April. The remaining 30% of my sales from April are going into May. And so here I have 60,000 sitting in May. And I know I did in my class, walk through a similar situation where we had collections and what we thought was going to come in off of a receivable schedule, went into a little more detail than they do in this class. And y'all you remember doing this? Okay. So you should have been exposed to it. Hopefully y'all all have been exposed to it. But the homework problems, you'll be able to walk through tables like this. So now in May, I'm expecting 70% of those sales. I don't remember what it was. So May sales, we're expecting 500,000. So we're collecting 70%, which is 350,000. And then in June, we're going to collect the rest, the 30%, which is 150,000. So you see how the table's flowing from one month to another. How much am I collecting for that month so that you know what the cash coming in is. Remember, we have to do that cash budget. Okay, what will the total cash collections for the quarter? What will be the total cash collections for the quarter? All right, so in April, we're collecting 170,000. We have 410,000. Let's see. And in June, we're going to have from those June sales. So remember 580,000. Going back to get the sales for June. So we're saying 300,000 times 70%. So it's 210. So on the schedule, we didn't have the June 70% coming in. So we have to figure that into the spreadsheet. So 210, I'm just gonna have to add them again because I can't remember. 150, 410, and 170. So it should be 940,000. So that would be D. They're not hard, just full time consuming to have to go through the different the different months and figure out what's coming in, what's the current month look like, what am I expecting for that month, and then add them all together. Okay. Now we're gonna look at the production budget. Okay, so we already did the sales and expected cash. So now we have to look to see how much we have to produce. If we're expecting to sell those units, we have to produce enough. And how many do we produce per month? And what do we want in our inventory at the end? Because you always want to make sure you have a little extra. So management at Royal Company wants ending inventory to be equal to 20% of the following month's budgeted sales. So what that means is I'm expecting to have 300,000 in sales in June. So I want to make sure that I've produced enough to cover my May sales, and I have 30% of the 300,000, which is the sales from the next month going in. So that way I'm only going to have to produce the 70% and whatever I want for the next month. Does that make sense? So we're looking at 20% of the budgeted sales for the following month. So you're always going to have some ending inventory based off of what the next month is. So on March 31, 4,000 units are on hand. So I have 400,000 on hand, and I can assume that that should be the 20%. We said 200,000 in April. So if I want to sell 200,000 in April, I want 20% on hand. That should be my sorry, not 200,000, 20,000 was how many units I needed. I was giving you the revenue number. So we have 20,000 times the 20%, which is the 4,000 units. That's why we have that on hand moving into April. Okay, so here's our spreadsheet. We have April budgeted sales, 20,000. Let me see if the next slide gives us the rest. All right, desired ending inventory, 10,000, total needs 30,000. Less the beginning inventory of 4,000. So that gives me a required production of 26,000. Okay, so we have 20,000 in budgeted sales. That means the units that we want to sell. Add the desired ending inventory. So in the end, we want 50,000 for May. We want 20% of that. So if it shows you on there. So we have the 50,000 times the 20%, that gives us our 10. So that's our desired ending inventory because we want to bring that into May. So it's telling us with what we need to sell, what we want in ending inventory, our total needs are 30,000. Well, how many do we have now? We have 20% of this month's budget already in inventory. So you're just going to produce the difference. You see, you're not going to produce the whole 30,000. We're going to deduct the 4,000 out, and the production is going to be 26,000. Have any questions on that? It makes sense?
Why do you do 20% of the next one rather than the current?
So they're telling us that this, in this example, this is what they want. They want in the ending inventory for the current month to be 20% of what the sales numbers are for the next month. And that's because when they go into the month, they want 20% on hand already for whatever reason. I guess they feel it's easier to produce if they have that 20% on hand. So maybe that gives them enough to where, what if they sell more? And so they're prepared. What if they sell a little less? Well, then it's not too much. So the reason why we're doing that is only because the example is saying this is how this company operates. They've set a plan in place for their budget that they're going to produce 20% of the next month's budgeted sales. So that's why. So no fancy reason other than this is how the company wants to operate. So that's why we have those 10,000 units in there. And then just keep in mind that 30,000 is what we need because we have to sell the 20, we have to have the 10 to move forward. What do we have now? We have 4,000 units. So we're only going to produce the difference, which is the 26,000. Okay, so what is the required production for May? So now let's go back. So May we have 50,000 units that we're going to sell. For June, we have 30,000 units we're going to sell. And how many did the company say they wanted? 20%. So the desired ending inventory is 6,000. So we'll have the 50 plus the 6 for our total. Let me see what lets me write in there. So that's the 20% of that. I'm going to add that. So we need a total of 56,000. How many did we have moving into the month? Do you remember? How many did we say we wanted in the ending inventory to move forward from the previous month? 10,000. So the beginning balance is going to be 10,000. So Then we deduct. And so we have required production of 46,000. Let's see if we're right. So it's saying, what is the required production for May? So we're saying 20% of the next month. We have the ending inventory was 10,000 that moved forward. And then we want to make sure we have those. So let's see if we're right. 46,000. Okay, so you see there's that 10,000 that's brought in for the beginning balance. And so you would do the same thing for June. In June, you would look to see what are they, setting their budget to be for July in order to know what's the 20% that I want in my ending inventory that I have to add into production. And then where was my ending inventory at? Well, when we move forward into June, that ending inventory becomes the beginning inventory that we have left at the end of the month becomes the beginning. So we just move that 6,000 down. And so I think I have a homework like this. You just have to fill in those cells, do the calculations. All right, July sales of 25,000 units times 20% is 5,000. So if they want that information, they're going to have to give it to you and tell you what's going to be the next month's production in order to be able to complete the table. So now we can look at what did we do for the quarter. So in the quarter, we have 100,000 units that we're going to sell. We have 5,000 units that we want in our ending inventory when we finish this quarter. And we look to see what our total needs were for the quarter was 105,000. Then of course you bring that beginning down to know what was my production. And then the required production tells you that it was 101. Okay, so let's look to our materials and see what they're telling us for this. So at Royal Company Week, 5 pounds of material are required per unit of production. So each unit, we have to have 5 pounds. How many were we creating and producing in it was 20,000, I think, for April. So it's me 20,000 times 5, right? We have management wants materials on hand at the end of each month. That's equal to 10% of the following month's production. And then on March 31, 13,000 pounds of material are on hand. Material costs $40 a pound. So let's look at the budget. All right, so this is our production based on the schedule that we just created. So this is what we have to produce from the budget. This is how we set up our budget with the needing the 20% for the next month and what we thought we were going to sell. So now I know April I'm producing 26,000, May is 46,000, and I'm going to break it down to know how much raw material am I going to need, because we're going to have to let somebody know in inventory how much they're going to have to order. So we need to figure that out. All right, so for the materials, it's $5 per pound. So production needs 100 and it's not $5. It's did I say $5? I can't remember now. 5 pounds per unit. So we're just going to multiply 26 times 5. So we have 130,000 for the production needs. We need to know what is the desired ending inventory. They told us 10% of the following month. So the following month, we need 230,000 I guess pounds in order to produce 46,000 units. So we're going to take 10% of that. So we need 23,000 for the desired ending inventory. So now I know production needs 130 plus the 23,000, so 153,000 pounds. And what did I have in the beginning that was given to us in the example? We had 13,000. So now I know that I have to purchase 140,000 pounds for April. Okay, next month, we're going to do the same thing. How much material should be purchased in May? Okay, so let's go back and look at it. So right here, We have 145,000. They say 10%. So it should be 14.5. $145,000 times the 10%. So we're going to put the 14.5 here plus the 230. So we have 244,500 that we need. And then how much do we have in our beginning inventory? Got to bring this number down right here. See it? To 23. So we have this. So we can deduct that from the 244. Oh shoot, I lost my number. I think it was 244.5 minus 23,000. So we have 221.5 that we need to purchase. That would be A. There we go. Okay, and then they show you June. And they fill it out, and then of course you have your quarterly totals again. So it just tells you how much we needed in production, what was going to be required for raw material, which was 505 pounds, what we're going to have at the ending inventory. And remember, we're going to be creating a balance sheet, so we need to know what that ending inventory looks like. So they're going to have to tell you what is of the next month in order to be able to figure it out. Okay, so the materials that we purchased on total was the 503.5. Okay, so how much is it to purchase? So we figured out how much we need. Now we need to know how much is it going to cost me? How much of my cash that I brought in through my sales is now going to go out in the cost of the material to produce those products. So it's 40 cents per pound. And it says 1/2 of month's purchase is paid for in the month of purchase, and the other half is paid in the following month. Well, they have to give you that because you have to know, am I paying for all of this up front? Am I paying for some of it now, some of it later, so that you know how is the cash being dispersed? How am I going to be, paying the vendors? So it's telling us that half is paid in the month that we purchase, and the other half is paid in the following month. And then March 31 accounts payable balance is 12,000. So remember, that's half from March. So now I know on my cash disbursement budget, I can see accounts payable at 3/31, 12,000, my cash is going to go out. Then it says for April production, 50% is 56,000. So I'm expecting to, it's 56,000. So I'm expecting that half of that's going to go out, and that's 28,000. So in the month of April, I'm expecting the 12,000 plus the 28,000. And so they're telling us here, since we don't have the table in front of us, we had the 140,000 pounds. So if we went back and looked, it should be the 140,000 is what we needed to purchase. And it tells us that that's going to cost us a total of 56,000. So that's where that number comes from. So we're going to take half of that. So half of it's going to get paid in April, half the next month, which is May. Okay, what are the total cash disbursements for the quarter? So now we're not just figuring out 1 month, they asking for the quarter. So we got to go back and do all of our calculations. So let's go back to what we need. Flipping back and forth. Okay, so for May, we need 221,005 in material, and in June we need 142,000. Okay, so for May, we have 221.5 times 40 cents. So that's 88.6, and half of that is 44.3. And then we had 142 times 40 cents. $56.8. And that is 28.4. Okay. So for May, we're gonna have, how much was it? May is 44.3. So 44.3 in May is gonna get spent, and then 44.3 into the next month. And then June production, 50% that we have to pay. June is 28.4. So we're gonna also have to pay half of that because we're ordering that in the month. So I guess we can just bring them over here. 44.3, 44.3, 28.4. It's 88.6 plus 28.4. So I think it's 185. So let's see. $185. So you saw how we calculated that, right? Okay, so then it tells us that our accounts payable at June is going to be the 28.4. So remember, we're not paying for that until July. So that's going to be a liability on our balance sheet. So hopefully, I don't remember what it was for what the customers owe us. Hopefully it's more than what we have to pay out. All right, so let's look at labor. So we can't just produce them. We have to have some sort of labor to go in to help produce the products. So now we're going to budget for them. So at Royal, each unit of production requires 5.05 hours, which is 3 minutes of direct labor. I don't know what we produce, and it's something kind of small, I guess, if it only takes 0.05 hours, 3 minutes. It's probably like a production of suckers or something like that. Oh, no, it can't be suckers. It's $10. Maybe a poppet. We're producing poppets. Those are popular right now. And I got poppets all over the house. Huh?
But would those weigh 5 pounds?
Yes, let's just pretend.
Okay.
We have heavy poppets. They're really thick, and so they weigh a lot. What else could be $10 that's 5 pounds? Because 5 pounds is a lot. Definitely not a sucker. Case of water. Okay. So it's going to have 3 minutes of direct labor. So the labor can be unskilled because the production process is relatively simple and formal training is not required, which means they're probably using a lot of machinery. It's probably automated. All right. Royal pays its workers at a rate of $10 per hour. It's pretty cheap. Okay, so we have our units of production. They listed it out for us for each month. How much time is it going to take? So we're doing 0.05, 3 minutes. So I guess that's 1,300 minutes. It's 0.05. No, can't be. It's 0.05 of an hour, which is 3 minutes. So it's, I don't know how many hours. So it's 1,300. All right, we have an hourly wage of $10. So I guess it is 1,300 hours. We produce in 26,000 units. It's 0.05 per hour, then it's going to be 1,300 hours times 10. So we have 13,000 in cost for April to pay our unskilled labor guy to produce our heavy poppets. I like poppets better than water. Okay, so let's look at overhead. So the manufacturing overhead is applied to units of products on the basis of direct labor hours. The variable manufacturing overhead rate is $20 per direct labor hour. Fixed manufacturing overhead is $50,000 per month, which includes $20,000 of non-cash costs, primarily depreciation of the plant assets. Okay. So here's our budget for manufacturing overhead. So we have how many hours, because remember, that's not going to be our activity that we're pulling from to do our costs. We're going to be looking at the labor hours. So the variable manufacturing overhead is $20. So that's fine because they gave it to us per hour, $20 per hour. So we knew what that was. Okay, we add that with the fixed manufacturing overhead of $50,000. And then we have total manufacturing overhead costs of $76,000. Okay, so they're giving us our total manufacturing overhead for the quarter of $251,000 and the total labor hours of 50/50, which is $49.70 per hour. So remember, in the beginning of the semester, we were kind of given some numbers to calculate what is it going to be for that predetermined overhead rate. And in this one, we're looking at it, I think we did this in the last chapter, was the one before last week. The variable manufacturing overhead and the fixed was separate when we looked at that on the test, where you had the variable manufacturer give it to you per hour, and we had to calculate what that fixed looked like. So anyways, they're just telling us how much it is per labor hour for variable and fixed going into it for the number of hours we have the guys that are producing. Okay, then it says less non-cash cost, which is $20,000. That was our depreciation. Let me see how it worded it. Yep, it's per month, and it's part of it is $20,000 of non-cash costs. So it's a monthly number. So that's our $20,000. Okay, so total cash disbursement for manufacturing is $56,000. So we're taking the total of the $76,000, which is the total manufacturing overhead cost. We're deducting out the non-cash. And the reason why they're doing that is because they want to know how much cash disbursements going out for the overhead. What do we have to pay for this overhead? And so that's why we're deducting the $20,000. Because depreciation, you remember depreciation from the first class? We've already bought our equipment and now we're saying, okay, it's going to be depreciated. Let's say it's over 5 years and it's $20,000 a month. So we're not actually spending any money. We're just expensing it on our income statement. We're over the life of the machinery that we're going to be using. Okay, so we have direct materials, 5 pounds at 40 cents is what it cost us. So it's $2. We have direct labor. They tell us it's 0.05 hours at $10. So it's 50 cents per hour for the direct labor. Then we have manufacturing overhead, which is using direct labor hours. So that's why it's got the 0.05 again. So at 0.05 hours times the 49.70. So remember, we calculated that based on putting that variable and the fixed in. We calculated how much it was in total for the quarter. So we could come up with how much it is for the manufacturing overhead using direct labor hours. What is going to be our number that we're going to use as an estimate? It's 49.70. So we're multiplying that by the 0.05 hours and it's $2.49. Okay, so the budgeted finished goods inventory. So the ending inventory in units, we have the unit product cost of $4.99. And what is the ending finished goods inventory? So we'd have to go back and look to see what was our ending inventory in units. So our ending inventory in units was 5,000. The production cost is $4.99. We just calculated everything out per unit so that now we can multiply it to the ending inventory to come up with the value of what is our inventory on the balance sheet. And it's going to be $24,950. So we just multiply them. Okay, so we have selling and admin. So selling and admin expense budget is divided into variable and fixed components. The variable selling admin expenses are 50 cents per unit sold. The fixed are 70,000 per month. The fixed selling and admin expenses include 10,000 in costs, primarily depreciation, that are not cash outflows for the current month. So that should be useful to us, just like the last time we had non-cash. So we're going to look at our selling and admin expense budget. So we have our sales, 20,000 units. Variable selling and expense is 0.50 cents. Variable expense will be 10,000. We have our fixed selling and admin expense, 70,000. So we have a total of 80. Less those non-cash, we're not going to be dispersing something that's depreciation because it's not a cash entry. So we have cash selling and admin expenses of 70,000. What are our total cash disbursements for selling and admin expense for the quarter? All right, now we got to go back and get all the numbers. Do we want to do that? Let's see. I don't remember what it was. The budgeted sales was what? Was it 50 for May? I'm not sure where the slide is. We're probably going to be going back. I'm not sure we're going to do that. Let's go forward and see the schedule. Because I think it's pretty far back. Okay, it was 50. Okay, so for May we had 50,000. In June we had 30,000. 50 cents is our rate. Multiply it out. We have our fixed of 70,000 less the 10,000. And so we come up with 230 for the quarter. So do y'all understand it? Where the numbers are coming from? Okay. All right. So now that we've done all of where the money's coming in, where the money's going out, we can do our cash budget. So we have our cash receipts. The section's going to show the cash inflows, excluding the cash received from financing, because that's not part of our production. That's something completely separate. And that would be if we got a loan from a bank, something like that. Well, there's other financing, you don't have to really go through a bank, but let's just say it's that. Cash disbursements section consists of all cash payments, excluding repayments of principal and interest. So we're going to make payments on loans, and we don't want to include those. We only want the cash disbursements that have to do with the production. And then the cash access or deficiency section determines if the company will need to borrow or if they'll be able to repay any previously borrowed funds. And then we have our financing section that details out the borrowings and repayments. So let's see what that looks like. All right, so we have some assumptions. We're going to maintain a 16% open line of credit for 75,000, maintains a minimum cash balance of 30,000, borrows on the first day of the month and repays loans on the last day of the month, pays a cash dividend of 49,000 in April, purchases 143,700 of equipment in May, and then 48,000 in June. has April 1 cash balance of 40,000. So we have to know what that beginning balance is in order to calculate out our cash budget. All right, so beginning is 40,000 in April. Total cash collections is 170. Now, we would have to go back to the slide where we had our cash. Remember, we had our little cash budget of what was coming in, and that was from, they said 50% for this month, 50% the next month. Remember how we had those columns? That's where that's coming from. So we have our total cash available of 210,000. Now, it's listing everything here based on what we did. So we're less our cash disbursement. So you see how it breaks it all down. So we have materials, direct labor, manufacturing overhead, the selling and admin. Those are all the tables we just looked at. The new is the equipment purchase and the dividend, because they just told us that information. And it gives us our total cash disbursement. And then it tells us at the bottom our excess. So we have enough, or are we deficient? And then it has our financing information. Okay, so the schedule of expected cash disbursements, we can go look at those budgets that we just created. And the materials is 40,000, direct labor 13,000, manufacturing overhead 56,000, selling and admin 70,000. Okay, and then it told us we had a dividend of 49,000 in April. So the total cash disbursements, that's what's going out, is 228,000. So these little notes that they have on here, this could be helpful when you're doing your homework, if you need it, where you can look at your schedules, but it's telling you where those numbers are coming from. What schedules, if you wanted to go back through the example. Okay, so we're deficient $18,000. So it says, because Royal maintains a cash balance of 30,000, the company must borrow 48,000 because they don't want to have under 30. So they got to cover the 30 and the deficit. So we're going to borrow 48,000. So remember, we have that line of credit. And then we're going to look at May. So we have 30,000 as our cash balance, cash collections of 410. So we have total cash available, 440,000. It's listing all of these are what we just looked at. The equipment was given to us a couple of slides back. So it says purchases 143,700 of equipment in May. That's where that number came from. It was given to us. Okay, so we have total disbursements of 400,000. Now we have excess of 40, which is great because we want to maintain that balance of 30, and we're there. So now we have a little extra money, and we might make a repayment. So it says, what is the excess deficiency of cash available over disbursements for June? Well, we would have to go back and pull all those numbers. So we're going to skip it and go right to the table. Okay. So here's the cash balance. We have our collections, total available 400. We plug in all of our numbers. We have the excess deficiency. We have an excess of 130,000. So now that we have a little cash on hand, we have a little cushion, we can pay back on, that 48,000 we took off the line of credit. So it's showing us that we have a repayment of 48,000, but we borrowed the money and it's been over a month. So the bank is going to calculate the interest and we're going to have to pay the interest back. So we have 48,000, which is what we borrowed, times 16%, which is really, really high. Hopefully we won't go that high again. 16%. And it's saying we're going to do times 3 over 12, which gives us our 1920. So we borrowed the money on April 1, and then we repay it back on June 30th. So we have it for all of April, all of May, all of June. That's why it's 3 months divided by 12. All right, and then at the end, we have a cash balance of 80,580. So you see how 1 month in production, we didn't have a lot in sales, we were a little bit deficit. We took advantage of our line of credit. And then we had to pay a little interest on it, but we had the money that we needed to continue production and pay employees. And then in May, when we have more sales, you get a little cushion. And then when we hit June, we have a large influx of cash. And so we were able to pay that line of credit off. Okay, so now our cash budget is completed. So we're going to do the budgeted income statement. So everything that we've done on these different budgets, we need to know, are we pulling it to the income statement or are we pulling it to the balance sheet? Do you remember what's on an income statement?
Everyone's the next slide.
Don't say it. Do you remember? What's on the income statement? Revenue and expenses. I want to know what my income is on an income statement. So I have all my revenue that's coming in from my sales that I budgeted, and then I'm going to have all those expenses that we just went over. So we're going to pull those to the income statement, and we produce that first because you can use what the net operating income is on other financial statements. All right, so here's our budgeted income statement. So we're budgeting sales of $1 million. Our cost of goods sold is $499,000. So now we know our gross margin, 501. If we want to know the ratio, you can calculate that too. Then we have our selling and admin expense, $260,000. And it's telling you, you get that from the expense budget. Okay, so we have operating income of $241,000. We paid interest of $1920. And so our NOI is $239,080. So we were profitable for that quarter. All right, so now that we've completed the income statement, we're going to look to see what does our balance sheet look like and what's included on a balance sheet. What kind of accounts? What's the formula for accounting? Come on, y'all know the formula? What was it? It is on one side. What's the assets equal liabilities plus owner's equity? Yeah, so that's okay. What's on the balance sheet? Assets, liabilities, and our equity. All right, so we reported the following account balances prior to preparing the budgeted financial statements. We had land of $50,000. Common stock of $150,000, retained earnings of $248,650, and equipment of $175,000. So we need that because all of that information is going to be on the balance sheet. So they've given it to us and it has to go someplace. All right, so we calculated cash. So we have our cash of $80,580. The accounts receivable was $90. Raw materials, $4,600. I'm showing you how they got that right here. So I don't remember if we ended in pounds or if it showed us the 4,600. I can't remember. But we have 4,600. We have finished goods inventory, 24,900. Land, which they just gave us. We have equipment. And I think the equipment, we have 175. But remember, we made that purchase. Was it in May? I think we made a purchase in May of equipment. So that's why it's 367. So we had 175, we purchased whatever the difference is. I don't even remember how much we paid for it. 367 minus 175. So it was 192. Is that what it was? Doesn't sound right. All right, we have our total assets of 617,130. All right, liabilities and stockholders' equity is at the bottom. So sometimes they'll do your assets on this side and liabilities and equity on this side because they have to equal, but sometimes they'll put them on top of each other like this. And we just want to make sure that the total assets equal those liabilities and equity. So we have accounts payable of 28,400, common stock 150, they just gave us, and then retained earnings, which they just gave us, was 438,730. Now, we need to calculate that out because if you have to figure out what your retained earnings is. Let's see. The difference should be that net operating income that we just calculated because that will close into the retained earnings. So that might be how they have it on here. So the 190,080, does that sound about right? We had 239,080 in income. We had the retained earnings, 240. I'm gonna see what the difference is. 248,650. Let me see what the difference was. I don't know if it was the dividends haven't come in yet. 239,080. I lost my calculation. Let me just move forward. Just trying to figure it out. It might show us here because the NOI is going to roll into your retained earnings, but you also have to deduct your payments for dividends. So there's a statement of retained earnings, and you should have gone over this in principles. So we start with our beginning equity, which they gave us of the 248,650. You're going to add in your net income, which was 239,080, and there's the dividends right there. So we take our dividends and we deduct that because we paid that out of our earnings. So we paid out 49,000, and then the ending balance is 438,750. So beginning equity plus income less dividends gives you your ending balance. Oh, that's it. So we're in balance, 617,130 and 617,130. So each schedule walks through how to calculate the budget for each section, and then you can put it all together and you'll have your budget. And so probably what will happen is when you run through that quarter, you're going to run some reports. They're going to print your budget on one column, and then it's going to print your actual on another column. You could have year over year, so you could see what the first quarter budget was last year, or what the actual were. All the reports could be different depending on how the organization wants to set it up. What do they want to see? What's important to them? So I went ahead and took one of the budgets that I had for 2021 for my company. Now, I don't have a production company, but we use the budget and we do look to see what was last year. What do we, have as an actual? What is going to be our number for this year? What are we projecting? And then what are we budgeting for the next year? So I want to show you what that looks like. And you can see that they have variances on the side. I think it's this one. So I grayed out the name, so you don't know which property it is, but it has a cover sheet. And then we go into a little cash disbursements. So it's just, we have partners and we'll disperse some of the money out, and they like to see, why is it not showing on there? Hang on. Maybe it's one of those things where it almost looks like it's disconnected. It won't let me slide it over there, so I'm not on two different ones. I just closed PowerPoint. Why is it not on there? For some reason, it's not seeing it all of a sudden. No, I don't see anything over here. I want it to be on both. There we go. I think I have it now. No way, it did that. Okay, so here's the cover sheet, just has the name and then the year of the budget. We have our disbursements, so we can show what the disbursements were in the previous years. How much are we expecting to go out that year? We look at our low cash, what we have that was coming out for a payment and what the projected cash flow is. So we'll do this real close to the end of the year to know what's available for the disbursements to go out right after we finish that year end. We're just estimating what we expect that we're going to be paying out in payables and mortgage payments and all that stuff in order to calculate what we have that's available to send out to the partners. Okay, then this sheet shows you an actual 2020. So, see if it lets me write with this one. So here's my actual 2020. Not let me write. What is that? Here it is. Okay, so the actual 2020 is showing me how much should I have in revenue? What were my additional revenue? Like we have gross rent potential, which is our rents that we collect every month. And then we have other things. So a lot of the leases will have percent rent. So if the store maybe is selling more than what their base rent is in their lease, it'll say, okay, we're going to charge you a percent of any sales over that. So it could be 5%, 8% of the sales that go over a certain point. So that's called percent rent. And then we have common area maintenance, which basically means anyone that's part of the building, when they sign the lease, they agree that they're going to give you their pro rata share. So maybe they're in 2,000 square feet of the total square foot, which is 1,198,000. So then that little small percentage is what they're going to contribute to all the expenses that pertain to any common areas. That's what that means. And so we have revenues that come in from that. We have revenues that come in from their pro rata share of insurance, taxes. We have some tenants that pay on HVAC. We have some tenants that pay for electric. If they don't have their own meter, we will provide and they'll just give us money every month for that. Water, same thing. We have rubbish pickup. And then we have some interest income. And it's not very much because in 2020, a lot of things, were changed where we weren't making a whole lot of interest, and 2021 is even less. So then we have some deferred rent and abated rent. So what that means is we have tenants that were in a space, and the reason why we had this for 2020 is because of COVID. So during COVID, some of the buildings were closed. So we had to abate some of the rent because they weren't making any money. So think about being an accountant and you can't work, you can't get the money, and you kind of like things get tight. So thank goodness we worked for a really nice boss that decided he was going to go ahead and help people and give them deferments, or he was going to give them abatements while people tried to do the government subsidized that they had was available. So then it tells me my total income, and then I have my operating expenses. So everything that goes into that, we have payroll, we have utilities, we have insurance, we have repairs and maintenance. So we're going to have a lot of different things that go into these buildings, and we have to project and budget, what do we think those expenses are going to be? So the property managers, they each do something a little different, but they'll go through a process and say, these are the monthly maintenances we have. We have grounds that we have to take care of, internal and exterior. We have monthly contracts for elevators, monthly contracts for AC systems. So all of those things, and you can put those into the budget based on your contracts that you have. But then there's other things that maybe need repairing. So maybe you have some repairs you want to do to the AC, or maybe you have some repairs you want to do to the plumbing. Maybe there's some maintenance where you're going to be pressure washing buildings or parking lots. So all of that will get budgeted. And we'll keep track quarterly when we're looking at the report will say, okay, it looks like you budgeted for parking lot maintenance for pressure washing, but I don't see that expense coming through. Can you tell me what's going on with that? So then sometimes they defer things to the next quarter, they just never got to it. And so we'll just note it, because sometimes those types of items can be big. And so you can note it on your variance. So we also have a variance report, which is a little bit different than this. And it'll show if we have unfavorable or favorable variances, and we'll give a description of why that is. Do we defer something, or did something happen in the building? And so then you'll see continuation of the operating expenses. And then we have our finance section. So this shows how much we're paying in the interest. And then we have our capital expenditures. So now maybe we've decided that we're gonna put in a new AC system. Maybe we know that we have new tenants that are coming into spaces, but we're gonna have to spend money to get them in there. So right now it's very competitive. A lot of people are working from home. We've lost a lot of tenants in some of our buildings. The occupancies are really low. And so they're being very aggressive to get tenants in. So maybe the space looks like this, but they want to, I don't know, maybe it's like, think of the engraving store. They have lots of glass shelves and things are real pretty and stuff like that. Maybe they want to come into this space, but they want all these beautiful little shelvings and all that. So the tenant can request some tenant improvements, and the company can say, okay, we'll go ahead and pay that for you if you sign a 5 or a 10-year lease. So depending on how much you're spending is maybe how much you want to get back on a lease. So if they commit to you for 10 years, you'll commit and go ahead and spend some money up front for them. Sometimes you can finance it. Maybe they'll pay for it, and then they'll just put a little payment in with their rent. So anyway, you have capital expenditures, and that's things we're budgeting for. And then we have other disbursements that we know are going to go out. So we have commission that we pay. If we have realtors that are helping us rent spaces, we'll pay them commission. And then sometimes you have casualties. So we had Ida last year, which has been a nightmare for me, but anyway, on the books. So Ida will have repairs that you have to have. And so we have to be able to put those casualty losses in place. So maybe it's all the way up to the deductible amount. Maybe sometimes it's just, like this, in this case, it's 117,000. So maybe it's not a lot. And then we have some TI reserves. What that means is if you have a loan on a property and you have leases in place that say that you will provide some type of improvement for them and they have a certain amount of time to use it, the bank will say, okay, but we'll keep that money on hand and hold it in reserve so that they can make sure they have the money on hand in order to honor that lease. So they're not relying on you having the cash. All right, so the way it's laid out is we have the actual 2020. We have, what did we budget for 2021? Let's look at tax, maybe, and insurance. We can look at that. So for 2020, the actual number was $3,038,000. We budgeted for 2021, $3,129,000. We're projecting that it's going to be $3,005,000. So maybe we budgeted 3% over to allow for a little cushion, but 2020, they gave us a reduced assessment because of COVID. They went into the properties and said, okay, we'll go ahead and reduce the assessment on what the property's worth right now because people weren't paying rent. So they'll reduce it. So then we go ahead and budget for 3% increase. But maybe the new assessment comes in and says, no, we're going back up to what it was. We're not going to have a lower rate this year. So now I'm projecting $3,005,400 for that expense. So the budget number is a lot lower than what we're actually expecting it to happen. So our report, we can see what do we budget, and then the projected right here is what are we expecting that to be. Okay, then this column here shows what the budget is. It looks kind of funky. It should be 22. I probably had the wrong, I have to do a second thing, print the right columns. So for 2022, what does my budget look like? And then you can run that too and look at it. But I just wanted to show you an example of what a budget would look like. And you can, you see these little letters on the side? We put footnotes. So this is what, footnotes look like. So when you have a budget, sometimes you might want to have notes that go with it. So maybe all of these little things we went through with the production team, saying that we want to have production of 20% of the next month of what we expect in, you can put that in the footnote. And then they'll know, that means we have to end. We'll know, okay, I'm gonna give you some notes to tell you exactly how we're coming up with these numbers. And so this is a good way to do that through footnotes. I need to take the pen off. And so, I mean, that's just a little quick example, but we also have, we use Access for all of our budgeting. And we also have some budgets that, close it, that will show what are the revenues going to be. In our case, instead of showing products and what we're going to sell, it's what are we expecting those tenants to pay in rent? What are we expecting those tenants to pay in those extra charges? And then what do we expect the vacancy to be? And where are those units? And then we run reports based on that too. So it's a whole bunch of different things. And then we have another software that you put in the, you put in all of the CAD drawings, and it shows the layout of the buildings and who's in what space and what the square footage is. So we'll put that in there. We try to make sure that the accounting system matches that. So they talk to one another when you put things in the accounting system. They'll update that system. So that's very common too for a lot of places to do things like that. But like when I worked for the AV company, we didn't really use a budget per se, but we did budget for jobs. So we would estimate how much material it was going to take, what was that material going to cost, what was the labor hours going to be, how much did we expect that we were going to pay for those labor hours. And instead of looking at a budget for a year, we looked at a job budget. So basically, what was my actuals versus my estimates, and where were my variances? And that can help improve on installs on jobs, order and equipment, different things like that. So depending on where you're working, you'll probably see some form of analysis that is showing you what is the actual versus the estimate. Am I budgeting and planning for the new year? Hopefully you're working for a company that has that in place, because that tends to be something that organizations that are organized, that are making money, those are the kind of things they're doing. They're getting their employees involved. They're making sure they're staying on target. They're making sure they're making money so that you can continue to have a job